Hi, everyone. Welcome to the next video installment of PIA's The Break. I'm Clare Irvine, Government Affairs Counsel for PIA, and joining us today is Brad Lachut, our Director of Government Industry Affairs, to talk about the National Flood Insurance Program's big, long-awaited change of switching their rating system to what they call Risk Rating 2.0. So I'm sure if you write any flood insurance, you've seen these updates taking place. So Brad's here to talk about what those updates are and what you need to know going forward.
Thank you, Claire. Yeah, as you mentioned, risk rating 2.0 has definitely been a buzzword in the insurance industry for, I don't know, the better part of a couple of years now. The name, the innocuous name, I think belies the importance of what this change is. So we're going to get into what risk rating 2.0 is, and then importantly, what the impact is going to be on all of your policyholders, and what we can predict from the future here. So digging right into it, let me talk about what risk rating 2.0 is. Arose by any other name. What this is really is just an update on the NFIP's flood insurance manual. It's the update of the rating manual. This happens fairly regularly. So in of itself, NFIP or FEMA, excuse me, updating their rating manual is not a big deal. What is a big deal is that this risk rating 2.0 manual significantly changes the methodology by which NFIP policies are going to be rated. For the better part of, let's see, 1968 is when the program was adopted. So since then, rates have generally been set based on flood zones and then elevation certificates for individual homes, right? So everybody's kind of grouped into one big zone. And if you're in that zone, here is your rate, and then you can get an elevation certificate to try to adjust it. What risk rating 2.0 is going to do is going to switch to individually rating properties. So instead of having our flood zones, we're going to have each property have each individual rate. The purpose of this is to make the policy rates match the actual risk of flooding, which has not actually existed in the NFIP for its history. I.e., what they're trying to do here is make the rates so they're actuarially sound. Which is a big deal. Anybody who knows anything about the NFIP knows that their debt runs in the billions of dollars with a B, and that is primarily because of subsidized rates that the NFIP has to offer or does offer through the program. So this rating change would significantly change that and make everything individual again, as opposed to the flood zone, with hopes of reducing that massive debt. So let's talk about the timing of this. Risk rating 2.0, when is this? So the first deadline is coming up, actually the end of this week, October 1st, 2021. All new policies will be subject to the risk rating 2.0 methodology. So any new policy between October 1, April 1, is going to be based on risk rating 2.0. All existing policyholders, though, they don't necessarily go over to the risk rating 2.0 methodology when their policies are up for renewal. During the period between October 1st of 2021 and April 1st of 2022, during those months, there's going to be two separate tracks, two rating manuals. One that exists for new policies, that's going to be risk rating 2.0, and then another that exists for existing policyholders who are up for renewal. And that's going to be based on essentially the old methodology with some slight modifications. Now, existing policyholders, are eligible for risk rating 2.0 between October 1 and April 1, but it will only impact them if their rates are going to decrease. So if you have a policyholder who's up for renewal, let's say December 1st, and under risk rating 2.0, their rates would increase. It will be the old methodology, that would apply to that policy until their next renewal date, which I'll get to in a second. On the reverse side, if you had somebody renewing on December 1st and their policy rates, premiums would decrease under risk rating 2.0, then that methodology would be used and not the current one. So now on April 1st, that changes. All policies after April 1, new policies or renewal, will then be subject to the risk rating 2.0 methodology. So that policy I mentioned that would renew in December, where the rates would increase under risk rating 2.0, they don't get another go at the old rates. Their next renewal date, they're going to be on the new risk rating 2.0 methodology. And again, that's for all policies, new and renewal after April 1. So we are going to have this weird in-between time where there is going to be two manuals. You have to be aware of that and see how it impacts policyholders. It could be a little difficult for producers. We'll get to maybe some solutions in a second. So let's talk about the impact on the policyholders. These stats are according to FEMA. So 2.4 million policyholders will experience rate increases of less than $120 in the first year. 627,000 will see their premiums decrease. That's actually the first time in the NFIP's history that they'll see premiums decrease for policyholders, and they're really trumpeting that. And you see these numbers are going down, and that's a good thing. 230,000 policyholders, they're going to see an increase between $120 and $240 in premium a year. 74,000 we'll see between 240 and 360. And then we have our smallest number here, 25,000 policyholders are going to have an increase between $360 and $1,200 a year. Now those 24,000 are going to be the ones that are going to be impacted the most by this. Those policyholders are likely going to be those who are going to be right on the beach, right on the coast. So if you do have coastal properties that you insure, make sure you check the rates to see where they're going to fall in this. For the vast majority of policyholders, there's going to be little to no impact to this change. But for some, a small set, there is going to be significant impact. So it requires checking on where your policies are and what the impact is going to be. And one thing I do want to mention here is the maximum premium is capped at $12,125 per year. That's not an increase. That's a premium cannot go over that rate no matter what. You build a house in the middle of the Atlantic Ocean and the rate would be capped at that. That's statutory. So that could change if the law changes, but as of now, that is the max anybody can spend on flood insurance, no matter what the risk is going to be of flood. So what's staying the same? Just quickly, rate increases are capped at 18%. So while rates under risk rating 2.0 will eventually get to actuarially sound levels, that is going to occur over a long period of time. Could be 20 or 30 years for some policies, depending on how much the rates need to increase where they are, because they are going to be capped at that 18% per year. So some policyholders might see that increase happen in 1 year because it's not that great. Others will see it again over a long period of time. Premium discounts for pre-firm subsidized and newly mapped properties will continue. So there will be some subsidies. They will be phased out over the life of risk rating 2.0 and as the rates naturally increase based on that cap. And then finally, policyholders will still be able to transfer their discount that they might have to a new owner as long as they assign the flood insurance policy when the property changes ownership. So that they can transfer that grandfathered rate or that lower rate, which is ideal for those looking to sell homes who don't want to saddle a new owner with hugely high flood insurance, which obviously impacts the resale value of a home. And now I want to mention a possible delay. As we get closer and closer to October 1st, there are more and more stories about some problems with risk rating 2.0 with its rollout in terms of educating both producers and policyholders about what the effects are going to be. This has raised some concern in Congress, where congressional leaders both on the U.S. House of Representatives and in the Senate have called for FEMA to delay implementing risk rating 2.0 essentially indefinitely until they can kind of figure it out. Associations such as PI National have called for a delay as well, although they've asked that the program be delayed until April 1st, and that all policyholders on April 1st then would apply, the risk rating 2.0, methodology would apply on April 1st. Whether those delays go into effect, I guess we'll see. But there is a call for the delay now. It is coming from some pretty substantial political figures. Charles Schumer, the Senate Majority Leader from New York, is on the letter. Senator Robert Menendez, who is a leader on flood insurance in the Senate, has also called for the delay. So there is some clout behind it, whether we'll see if FEMA responds or not. So with that, if anybody has any questions, you can always contact Clare or myself at the Resource Center. In addition, as always, there's links below with additional resources on risk rating 2.0 if you have any further questions. So with that, I'm going to turn it over to Claire to see if she has any questions, and then we'll conclude.
Yeah, I mean, you pretty much covered a lot of the basics of the program. I guess you mentioned that there's been some bugs in the rollout of risk rating 2.0. So for policies that are up for renewal, that might actually be one of the like 627,000 that see a decrease, but might have issues changing the policy on renewal in the next couple of months. Are they able to effectively make that savings retroactive?
That's a really good question. Thank you, Claire. The answer is yes. So there is a retroactive feature, I guess, a risk rating 2.0, which hopefully will help producers if there is no delay, because it's going to take a little while to get everybody up to speed and figure this out. So if it does take a little while to get a policyholder within the correct rating system, you're rest assured that you can get those rates, the new rates, retroactively applied. So there is no penalty for that policyholder for getting in after the gun, if you will.
Yeah. So if you're experiencing issues, particularly in the first weeks of October, it's the discount can still be accessed in November or December. So I think that makes it a little easier for people to hopefully work through what I'm sure is going to be not the most pleasant renewals process.
No, exactly. And really the key here for producers is use this as a touch point for your flood insurance clients, because this is going to impact all policyholders one way or the other. Hopefully most, it won't be very dramatic, but regardless, being able to reach out and talk to your clients about what these changes are and what the possible impact will be on them is very important.
Yeah, and if they see the actuarially sound amount, but they still are probably at least a decade away from actually accessing that, it's a great opportunity to discuss with them that it's not going to go up to that amount next year or even 10 years from now, that increases are still limited year to year.
Absolutely. Great point, Claire. And also obviously mitigation efforts are being encouraged. So for those policyholders that might be dramatically impacted by these new rates, there are steps that they can take to hopefully mitigate that risk and lower those rates down. But that is obviously a long-term outlook there.
Okay, well, thank you very much, Brad. I hope hopefully that gave everyone watching a good overview. If you have any questions about it, please let us know. We're happy to answer further questions or more specific questions as they arise. And have a good day.
Thank you, everybody.